Okay. All right, double tax agreement is a topic we regard to when we talk about when a Malaysian company, all right, business in Malaysia doing business in another company, in another country, right? So that's another topic we call it as a cross-border activities. It means that you're looking at two different countries, all right, doing business. And when you have business in overseas, or even if you're talking about an investor from overseas having business in Malaysia, what is the tax implication? Yeah, so what happened is that, of course, in order to encourage foreign direct investment, we want people to invest in Malaysia, we give a lot of tax incentive, yeah, in order to attract them to do business in Malaysia. All right, on top of this tax incentive, we also have an agreement, all right, agreement between Malaysia and the other country. So whenever Malaysia has an agreement with other country, that agreement for income tax purpose, we call it as a double tax agreement, DTA. Yeah, we call it as a DTA, double tax agreement. And as of March 2019, all right, it says that Malaysia has signed a total of 76 treaty arrangement. Right, means that kalau one Malaysia and Indonesia, one DTA, Malaysia and Singapore, 2, Malaysia and Japan, 3. So total we have 76 treaty arrangement. All right. So why do we need to sign a treaty arrangement? Of course, in order to alleviate, means that in order to avoid either wholly or partially the burden of double taxation, all right, on the same income derived by a taxpayer. All right. So what do you mean by burden of double taxation? It means that if you're talking about a Malaysian having a business in, let's say, in Japan, all right. So for that Malaysian, right, in Japan, he has to pay tax in Japan because business is in Japan, for example. All right. But at the same time, as a Malaysian, all right, that Japan income may also be taxed in Malaysia, for example, all right, on certain, but previous, of course, in this case for Malaysia, income from Japan is exempted under section, from YE 2004, under foreign source income, right? But you're talking about visa, industry, banking, insurance, shipping, and airlines. All right, visa for this type of industries. All right, the law says that wherever income is derived, if the company is a Malaysian company, Malaysian resident company, tax will be imposed in Malaysia, regardless where the income is derived. Yeah, so in that case, for this industry, banking, insurance, shipping, and airlines, wherever income is derived, it will be taxed in Malaysia. So let's assume now, we're talking about an airline industry. All right, for example, when they touch in Japan, maybe, because remember, income tax is a local, or we call it as a domestic law. So if the law in Japan says that whatever business that derive in Japan have to pay tax in Japan, then they have to pay tax in Japan. At the same time, Malaysian law says that for visa, in the case of airlines company, whatever income derived, then you have to pay tax in Malaysia. So for this income, the same income being paid by the Malaysian company in Japan as well as in Malaysia. So that's what we call a double taxation, double tax on the same income. So in order to reduce or to alleviate the burden of double taxation, that's why we have come up with the double tax agreement. All right, agreement between Malaysia and Japan, for example. Whenever we have this case, so how are we going to do it? All right, in order to avoid the same person to avoid paying the same tax or double tax on the same income. So that's why we come up with the double tax agreement. But on top of that, all right, the treaty agreement between countries are also to facilitate world trade. For example, yeah, when Malaysians venture into foreign country, the local investor, which are Malaysian, would like to know whether such entity constitute trading in or trading with the foreign country. So later we'll see that whether, what do you mean by trading in? What do you mean by trading with the foreign country? Because trading in and trading with, all right, will have a different tax implication. With the existence of double tax agreement, the scope of tax is much clearer, certain, and without confusion. Similarly, whether a foreign enterprise having a transaction with Malaysia is subject to Malaysia or not is spelled out in the double tax agreement. So when you have an agreement, so it's very clear. All right, so you don't know what kind of business that you want to have in the other country, then one of the consideration that you want to look into is the tax implication. all right, because tax, paying of tax is one of the costs, all right, doing business. So you have to consider the tax implication whenever you want to invest in another country or even investor to invest in Malaysia. So that's why we try to make our tax very attractive, right? So that we can invite investors from other countries to invest in Malaysia. All right. Of course, to promote technology transfer, Malaysia encourage foreign company to transfer technology and scientific knowledge to Malaysia. As such, DTA would normally accord a lower tax rate or royalty technical payment. So remember that years ago, we do have that what we call pandang ke timur. All right, means that we are looking at Japan, for example, where we make an agreement, transfer knowledge, technology especially from Japan to Malaysia. So the transfer of knowledge later, we see that even if you remember that withholding tax, all right, we have the technology or payment of royalty is subject to withholding tax. All right, for example, 10% withholding tax. So whenever we have this payment because of the non-resident issue, all right, so how can we encourage the continuous transfer of technology to Malaysia is to reduce our withholding tax. So that can only be done through double tax agreement, because why? In the tax law, we can't simply change Income Tax Act. So what we do is that we can come up with the double tax agreement between countries, and under that agreement, we'll mention the implication. For example, if the withholding tax normally is 10%, maybe because to promote the exchange of technology between the two countries, for example, Malaysia and Japan, so the tax rate instead of 10% may be lower to 8%, right? Or maybe 5%, 0%. It depends, yeah, how we want to make it very attractive. Okay, so when you have this, okay, you have Malaysian tax saying that, okay, Income Tax Act say that withholding tax is 10% and double tax agreement says it's 8%. So which one that you have to follow? All right, so remember that the Income Tax Act is a domestic law. All right, it's applied only in Malaysia, but double tax agreement is between Malaysia and Japan, for example, yeah. So it's an international level. So whenever there's a dispute between Income Tax Act and double tax agreement, which one do you think that you have to follow? You not follow Income Tax Act or double tax agreement?
DTA.
To follow the double tax agreement because that one is the international level. All right, so whenever there's a dispute between double tax agreement and income tax in Malaysia, then you have to follow double tax agreement. Yeah, so that's why when you want to invest in another country, you have to check double tax agreement. Do we have any DTA between Malaysia and the other country that you want to invest in? Then you see the tax implication. All right, maybe you are not aware that the tax rate that you have to pay is lower compared to the normal tax rate. Yeah, and then prevention of tax avoidance and evasion. So because you have agreement between two countries, that means that international business operation may give rise to avoidance and evasion. Means that you can identify if there is any business which is underground. All right, so you may avoid those activities. All right, because in Malaysia and Japan, okay, if there is any Malaysian doing illegal business in Japan, then Japan will have to inform Malaysia. Similarly, all right, if there is any Japanese that is doing illegal business in Malaysia, then we have to inform them accordingly. Yeah, treaty countries will exchange information and cooperate to eliminate artificial tax avoidance or evasion. This will involve international audit on the multinational company. Yeah, so this is among the objective of why we have double tax agreement. Okay, so when talk about the objective is actually to relieve, all right, to relieve the burden of double tax. So what kind of relief that we have, yeah, applicable under double tax agreement? So remember that the DTA is from one country to another. So the DTA between Malaysia and Japan may not be similar to Malaysia and Singapore, all right, because it's individually, but generally almost the same. Yeah, so generally it's the same, but maybe there are some specific information or specific provision that will give a lower or a bit different from one country to another. Okay. All right, exemption in country of origin on income. All right, double tax can be determined by reference to country of residence, which is the home country, in three ways. All right, exemption in the country of origin on income arising therefrom to a resident of the other country. Tax credit. So number one is the exemption on the income. income on the foreign income. So what we are saying that you're looking at being a Malaysian, for example, all right, income in the foreign country. So what would be the tax treatment in Malaysia with regard to the foreign country, foreign income? Yeah, and remember we're talking about foreign income. Here we are referring to income from visa, right? Because we're talking about other income is exempted because it's foreign source income. Yeah, okay, exemption in the country of origin on income arising therefrom to a resident of the other country. You are giving tax credit, number 2, yeah, tax credit against a person tax in his home country or for tax suffered on that income in the other country. And then we also have tax deduction against total income the home country. So there are 3 lah. 1 is tax exemption, number 2 is tax credit, number 3 is what we call tax deduction. So how does that work? For example, let's see the example in 51.1. Okay, Chuan Berhad is a resident in Malaysia for tax purpose. Operates banking. See, the business is a banking, so it falls under BISA. So that's why we are looking into this lah. Operates banking business in Malaysia with an annual profit of 100,000. The company is planning establish a branch of its business in one of the 3 countries, Nirvana, Paradise, or Heaven. You nak pergi which one? An annual profit of 80,000 is projected for the proposed branch, and all available profit will be remitted into Malaysia. All right. So then you see that the following information relate to the tax system of each country. Rate of tax sim. All right. In this case, we are the example is easier because they give you the same scenario, but the difference is the method of elimination. All right. So every country give you tax rate 20%. And all countries have an agreement with Malaysia, and method of eliminating double tax agreement under Nirvana, we call it the first method, which is full exemption. Second one, Paradise, is the full credit, and Heaven given a full deduction. So looking at the same income, same tax rate, but different method of elimination, we'll see the implication on the chargeable income or tax liability to the Malaysian company, in this case, Chuan Bank Berhad. Do you get that? Okay. So advise in which country the company should locate its branch in order to minimize its overall tax liability in 2019. Show all relevant calculations to support your advice. Okay. If the branch is located in Nirvana, so Nirvana, remember, is 20% tax on the foreign income. So how much is the foreign income? Foreign income is, foreign income is 80,000. Okay, Malaysian income is 100,000. Okay, so Malaysian income is 100,000, foreign income is 80,000. So total income by this company is 180,000. So now we are talking about income in Malaysia. How are we going to tax you? Okay, because you know that total income 180,000 under the first full exemption. Okay. Full exemption, it says that less foreign income, in this case, fully exempted under double tax. So from total income here, this is your what we call foreign source income. When you are given full exemption, then you terus tolak. All right, you take out your foreign source income, 80,000. Now your chargeable income is 100,000. And remember that 100,000 is taxable in Malaysia at 24% tax rate. So your tax liability is 24,000. Yeah, so in this case, there's no bilateral credit, not applicable. Because why? Because in this case, under full exemption, there's no bilateral. Later you see what is a bilateral. Yeah, and so in totality, remember that in Malaysia, income which is taxable is 100,000 times by 24% is 24,000 ringgit you have to pay in Malaysia. But remember, the same income, 80,000, you have to pay in Nirvana 20% tax rate. All right, so you have paid 20% in tax in Nirvana. So in this case, you have paid 16,000. So totality in terms of your tax liability is 24 plus 16,000. So it means that how much you have to pay tax in Malaysia, how much you have to pay tax in Nirvana. Yeah, so total is 40,000. So how do you see that tax exemption? In this case, it says that in Malaysia, all right, in Nirvana, you have paid tax 80,000 times by 20%. Yeah, but in Malaysia, because the agreement is full exemption, means that total foreign income is given as an exemption in Malaysia. So you take out that amount of income is not taxable in Malaysia. But in terms of the total tax exposure, you have to pay in Malaysia 24,000. All right, taking into account the exemption plus tax that you have paid to Nirvana, which is 16,000. Is that clear? Am I too fast?
Yeah, madam.
Okay, all right. Okay, now let's look at the second one. Second one is we have your paradise. Same, we have 20% tax rate in paradise, but the method given is a full credit for tax. All right, so how does it work full credit for tax? All right, in paradise, we have Malaysian income 100,000, foreign income is 180,000. So chargeable income is 180,000. Okay, from this 180,000, we have income tax of 24%. Remember, this one method is what we call tax credit. Yeah. So we compute tax 24% on the total income. So you have your 43,200. All right. Income tax at 24% based on the whole amount here. Okay. When we say tax credit, then you have to do the computation further. All right. So we are going to look at the bilateral. All right. Why do you mean by bilateral? Whenever you have an agreement between one country and the other country, in this case, you have agreement with paradise. All right, so we are going to use the formula what we call bilateral. So bila ada bilateral, maknanya ada agreement between two countries lah. But if there is no agreement, then you say that you are going to use unilateral. All right, later at the next pages, all right, you see that there is mention about bilateral and unilateral, and they show you the difference between the computation under bilateral and unilateral. So in the case of this paradise, because we do have an agreement with the other country, then you are going to use bilateral. So what is the formula for bilateral? It says that bilateral credit is whatever income that you, whatever income tax that you have here, 43,200, you're going to give a tax credit. So how to compute the tax credit? Number one is that you have to look at the lower of foreign tax. How much you pay for the foreign tax? You have to pay 20% on the foreign income, 80,000, which is 16,000. And then you compare that amount, all right? What is your foreign income? Which is the 80,000, right? 80,000 over 180. So we are talking about what is the portion of your foreign income over total income. Total income is 180,000 times by 43,200 is the tax liability. In other words, what you can do is that you can only take that 80,000 times by 24%. You will get 19,200. Means that the same income, all right, 80,000. Well, how much if you pay in Malaysia? You have to pay 24%. Yeah, the foreign income, if you were to pay in Malaysia, you have to pay at 24%. So, but the foreign income, the foreign tax rate is 20%. So, number one is 16,000. Number two is 19,200. Okay. So, in other words, you want to times by 80,000 times by 24%. So, you should get 19,200. So, whenever you have this 16,000 and you also have 19,200, the amount that is given on be given as a credit is actually the lower of, right? So the lower of between these two is 16,000. So 43,000 minus 16,000, then you should get your 27,200. So that is the final tax in Malaysia under full tax credit. All right, because you are given tax credit, all right, against your tax in Malaysia. But the net tax that you have to pay, instead of 43,200, you only have to pay 27,200 in Malaysia. But remember, you also have paid 20% in paradise. So that 20% is 16,000. So total tax exposure, if you were to have business in paradise, is 43,200. So as compared to the first one, Nirvana, right, tax liability is total exposure is 40,000, but if you were to have in paradise, you have to pay a total of 43,200. So given an option, you would like to put your business in Nirvana or paradise?
Paradise.
Nirvana.
Anda pasti?
Nirvana.
Nirvana.
Yes.
Why
The lowest
Nirvana?
tax.
Because it gives you
Lowest
exposure. So that's the objective.
Yes.
You don't want to pay more tax, right? So given an option, you want to have a business in Nirvana as compared to Paradise, because why? Nirvana will have a lower tax exposure. What about Heaven? Heaven give you a tax deduction, all right? How does tax deduction work? So you see that, okay, tax deduction in Nirvana, Malaysian income 100,000, foreign income is 80,000, total 180,000, all right? But the deduction is given directly, all right? So from 180,000, deduction for foreign tax is 16,000. So dia terus bagi direct. So 180 minus 16,000, you have 164,000. 164 times by 24%. So if you look at here, right, the tax exposure in Malaysia only is 39,000. But plus your tax paid in Heaven, which is 20%, is 16,000. Total tax exposure is 55,000. So you see that if given a option, you do not want to go for tax deduction, you want to go for tax exemption. But this agreement must be agreed by two countries. Yeah, so both countries agree that, okay, let's give a tax exemption, then you apply the rules like in Nirvana. Kalau nak tax credit, then you apply the Paradise. If a tax deduction, then you apply the one in Heaven. Can you see the difference between the three? Yeah. So kan? Clear? Alright. Based on the above, the branch should be located in Nirvana in order to minimize overall tax liability. So if I say that what are the three methods of tax relief under double tax agreement, then you have to mention three items and give example. Alright. Sometimes they require you to do some computation to justify your answer. Okay, you should be able to do that lah now, right? So you must understand what is exemption, what is a tax credit, what is a tax deduction. Okay. Okay, how to seek treaty protection, right? The governing principle of a treaty is to avoid the possibility of double tax on the same income. There are many articles. So dalam double tax agreement, we have what we call articles. I'm not sure if I share with you double tax agreement. Hold on, yeah. Let me see.
Madam. Oh, madam. Madam.
Hold on, yeah. I'll check double tax agreement with Australia. Okay. Alamak, masa ni lah bateri nak habis. Hold on, yeah. Where am I? Stop sharing. Let me share. Mana dia tadi ya? Tak ada pun. Hold on, tak jumpa. I have to pause recording for a while. Recording. Okay. The total tax liability means that for the company in the example whereby, for example, we talk about Nirvana, all right? So it means that in Malaysia, the company will pay in Malaysia is 24,000, right? You only pay in Malaysia 24,000, but the 16,000 you pay in the other country, 16,000. It's just that 40,000 is the total tax exposure. How much you have to pay to Malaysia and Nirvana. Alright, so if you look at in Nirvana or even in Paradise, it's the same. It's the same. It's 16,000. But the totality, because you're using three different methods, then you have to see now whether you have to pay 24,000 in Malaysia, or you have to pay 43,000 in Malaysia, or the last one you have to pay 39,000. Sarah, at foreign tax. Oh, sorry. Under tax, apa nama dia, deduction, you have to pay 39,360 in Malaysia, 16,000 in the other country lah. Yeah, alright. Okay. Next is how to seek treaty protection. Alright. It means that who can actually, if for example you have Malaysia and Japan. Alright, who can actually benefit? Any Malaysian, alright, any Malaysian that want to have business in Japan can actually benefit from the DTA between Malaysia and Japan. The governing principle of a treaty is to avoid possibility of double tax on the same income in the treaty agreement. articles, yeah. So that's why I want to refer to the DTA just now, because it says that it's not section 1, section 2. We refer to article 1, article 2, article 3 onwards, right? Defining the scope of treaty, which include the person entity to which it applies, taxes covered, and the territories, yeah. So the coverage of it should be understood before one embarks on any transaction with the treaty country. In order to reap the maximum benefit from DTA, the understanding of the following concepts are crucial, right? So number one is about resident status. Okay, remember that resident status for individual and company are different, all right? But you can also apply whether you are individual or your company, then you have to see resident status, yeah? Some countries subscribe to the principle that a resident will be subject to tax on worldwide income. All right, for example, in America, all right, American citizen, dia tak panggil resident, American citizen have to pay their tax to America on their income wherever derived. All right, so even if the American is actually working in Malaysia, they still have to pay tax in America. All right, that's why their country are very rich. Right, hence it's beneficial to avoid being a resident of this country. So for example, that's why if you're no longer staying in America, for example, you may have to opt to give up. All right, for example, in this case of America, is citizenship lah. All right, but not many people want to give up their citizenship because it's not easy to get citizenship. Citizenship is different from the resident status. So for income tax purpose, of course, we look into the resident status. All right. For example, in Malaysia, if you have 182 days in Malaysia, for example, then you are Malaysia resident, individual. All right. The other countries may have, remember you have your option A, B, C, D. Other country you may be a resident under different section, all right? Different circumstances that allows you to be a resident of the other country. So let's assume that you are a resident of Malaysia and Australia, right? For example. So if I say that Australia, it doesn't matter on whatever income, is a worldwide basis, for example, yeah. So it means that even though you are Malaysian resident, at the same time, you're also Australian resident. So whatever income that you derive, you have to pay also to Australia, all right? So in that case, you may want to decide to let go of one of your resident status. So that's why you say that avoid being a resident of this country. So if you know that in Malaysia you need 182 days, so you don't want, if you don't want to be a Malaysian resident, you don't need that 182 days. You don't want to be in Malaysia for 182 days. All right, but careful, you also have section 71A, B, C, and D. All right. Or shift the resident to tax haven or country where resident is restricted to territorial scope or modified territorial scope. All right, with regard to withholding tax, remember that withholding tax imposed on a non-resident person. Where developing countries have DTA with developed countries, benefit can be derived where the DTA provide for a reduced rate of withholding tax or even tax exemption. As I mentioned earlier, maybe the normal tax rate withholding is 10%, but if having a DTA, maybe it reduced to 8%, 5%, or maybe 0. Yeah, so be careful with that. All right, then you have the issue of permanent establishment. And the PE, we call it PE, permanent establishment, yeah? All right, under double tax agreement, PE is one of the most important articles, right? So if you have a business income, all right, you're not referring to business income, you're not referring to visa or what, all right? Business income. In the business income article of the MOHD DTA, PE is the factor to consider to determine which country will have the authority to impose tax on a particular business activity. All right. It is normal that a contracting state will only impose tax on business if it is attributable to a PE. So now you have the term what we call, all right, as I mentioned earlier, all right, permanent establishment. You trade in or you trade with, right? Trade in and trade with, okay? If you have a permanent resident, permanent establishment, it means that you trade in Malaysia, all right? But if you only trade with Malaysia, then you don't have permanent establishment. In other words, what you're saying that if you have PE, it means that you are trade in Malaysia. If you do not have a PE, then you are trade with Malaysia. So if you are trade in that country, all right, then you have to pay tax in that country. So if you trade in, then you have to pay tax in that country. So a person can have, for example, you can have a business in Malaysia, but you only trade with Malaysia. So for that purpose, all right, because you only trade with Malaysia, you don't have to pay tax in Malaysia, even though you do business in Malaysia. But if you trade in Malaysia, then you have to pay tax in Malaysia. All right, so that is so how you decide whether a company trade in or trade with, that's why we refer to the permanent establishment. So what is a permanent establishment? So it says that, right, if there is no PE, then you're trading with. All right, elimination of double tax. One should be aware the provision of granting or credit for underlying tax. Okay, dekat sini 3.3 ni, it just mentioned about these are the things that the crucial understanding of your concept, all right, under double tax agreement. So they mentioned satu resident, one is withholding tax, number 3 is the PE. But here it doesn't mention what is PE, all right. Later we'll see that the PE actually have its own subsection later, all right, under this chapter. But the other thing that you have to look into concept under double tax agreement is the elimination of double tax. All right, one should be aware of the provision for the granting of credit for underlying tax or credit for tax sparing. Sometimes they may impose conditions such as beneficial ownership shareholding. Means that in order for a company, for example, or an individual, all right, to enjoy elimination of double tax, then you have to fulfill certain criteria. So you have to look into that also lah. All right, because it's not easy to give tax exemption actually, yeah. So you have to fulfill the conditions, all right, in order for you to maximize whatever as elimination given. Okay, and you also have to understand with regard to the profit extraction, all right. Royalties, interest, and dividends are usually accorded reduced rates in most of the DTAs signed between Malaysia and treaty countries. Now you're looking at, for example, if the person is a non-resident person, all right, non-resident person receiving those income from Malaysia, all right, he's subject to withholding tax. So withholding tax means that you have to see whether there is any lower. It is therefore important for the company to decide what form of transaction or business present it should have in those countries in order to maximize profit extraction. Profit extraction means that how much you want to bring back to your own country. All right, so sometimes you're talking about business income, you're talking about interest income. So you put money in other country, how much you want to bring back to Malaysia, for example, sometimes it is subject to tax as well, right? Especially if you are in the visa. Articles on non-discrimination and mutual agreement. So this article is to ensure that a national, resident, or citizen of one of the contracting state is given the same treatment as a national of the other country when he derives income from or is taxed in the latter. The mutual agreement article stipulates that if a taxpayer is not satisfied with the action of one contracting state, he can at last resort appeal to the contracting state of which he is a resident. The two tax administrations are supposed to consult each other with a view to resolve the issue should there be any. So in other words, it means that if there is any issue regard to double tax agreement, all right, for example, a business is not being treated well, not in accordance to double tax agreement, you can always go and appeal. And both countries, officers should be responsible, all right, to help you in settling the issue with regard to the double tax agreement. Okay, overspill problem. What is an overspill problem? Malaysia generally tax income based on territorial. Thus, tax relief is only given in respect of the portion of income which is remitted back and which is then subject to tax in Malaysia. Any surplus or credit for foreign tax over Malaysian tax payable would be a permanent loss. This only applies to resident individuals. With the new amendment from YA 2004, only resident companies involved in the banking, insurance, shipping, and air transport will continue to rely on the bilateral relief to mitigate the Malaysian income tax payable. So I mentioned earlier, we are talking about visa. As these companies are on a world income scope basis, wherever income is derived, Malaysian tax will be levied when foreign business income accrued overseas. Bilateral relief will then be accorded. So in this case, we have gone through just now example, when we talk about bilateral, it means that the tax exemption, the tax relief is in the form of tax credit, all right? So you're going to use the formula of a bilateral, right? So remember that it's only for visa, because other than that is tax exempt foreign source income. Okay. All right. Example regard to resident status, dead hard, mati mati. Right, a Malaysian resident company is required to pay an interest amount of 20,000 to Japan, a Japan resident. Withholding tax rate normal is 15%. However, Article 11 of the DTA between Malaysia and Japan in 1999 allows the reduced rate of 10% to be applied to the Japan resident. So this is an example whereby we say that it's not totally eliminate, but reduce your tax burden. Yeah, from 15% now you only have to pay 10% on the you have to pay 10% tax on the income. Okay. So this one is the resident status. Right, permanent establishment. So this is the topic on permanent establishment lah. It's very long, right? So in other words, it says that, as I mentioned earlier, the central issue is which of the country has the right to tax on the gains or profit earned therefrom. Yeah. So you're talking about you are having business in other country, you have to pay tax in the other country. Right, so we have to look into the PE lah. So again, PE here refer to the PE as stated in the double tax agreement between Malaysia and the other country. So if you're looking into Indonesia, the PE requirement may not be the same as data DTA between Malaysia and Australia. All right, so you have to be very careful lah. You must first identify which country that you're going in, and then looking into that double tax agreement between Malaysia and the other country. When a foreign enterprise is carrying on the business through a PE in Malaysia, where profits are earned, such profit will be taxed in Malaysia, leaving the country of the foreign to grant relief on the double taxation. So in this case, we are talking about tax exemption method lah, number one tadi. Bila you give relief means that it could be tax exemption, but it could also be given as a tax credit. It depends on the agreement. On the other hand, when the foreign enterprise does not establish a PE in Malaysia, the business profit may be exempted from tax in Malaysia. However, withholding tax issue should be considered in situation where PE is not present. So sometimes you don't have a PE in Malaysia, but you have to say if that business or that company is a non-resident company. If a non-resident company or individual, then we may have to impose withholding tax. Yeah. Okay. In the Malaysian treaties, the term PE means a fixed place of business in which the business is wholly or partly carried on. It also includes a place of management, a branch, an office, a factory, a workshop, a mine, oil or gas well, quarry, or any place of extraction of natural resources, including timber or forest produce. All right. So this one example, for example, you're talking about Malaysia, all right, Petronas. Let's say Petronas lah, all right. They do have, now what they have is that dia ada plant, right? So normally the one that used to extract natural resources in the sea, right? I do not know how the term is lah, right? So it's normally is outside, right, in the shore, right? Offshore lah, kita panggil offshore, right? So that could be a permanent establishment, all right? Because there is a place of extraction of natural resources. Even though you don't have any company or what, all right, it's just that you have that facilities to extract resources, all right, that could be, you can have a PE in that. So you have to look at the area too, is it belong the ocean, no? All right, does it belong to Malaysia or other countries? If it belongs to other countries, right, you have to pay tax because why? You have the PE in the other countries. Right? And now Malaysia, for example, dia ada apa dia panggil, there's a ship, a big ship that actually moving around, right, from one place to another. All right, so instead of having a fixed place, so this ship actually move and actually meant for extracting natural resources. In other words, it's the oil and gas lah. All right, so that is also another way of looking at a permanent establishment. All right, another one is that if you have a building or a building site or construction, installation or assembly project which exists for more than 6 months. So for example, if you have a foreign enterprise, right? Let's say like MRT project, yeah? We have a big MRT project. So it's assuming that one of the contractor is a foreign contractor. And that foreign contractor have a business site or building site or construction. Right, building site or construction, it doesn't have to be one building. It could be just remember the container, right? If it's made as an office, for example, right, and that exists for more than 6 months, then you have the PE there. Right, so once you have more than 6 months, because DTA here generally it says 6 months. So if you have 6 months then and above, then that is your permanent establishment. That means that you now have a PE in Malaysia. Bila ada PE in Malaysia, then you have to pay tax in Malaysia. Right. It should be noted that the 6 months time frame does not apply to all DTAs. For example, in Australia, DTA Malaysia and Australia, the period is only 3 months. So that's why you have to look into each DTA, right? Malaysia, Singapore does not stimulate any time frame. Means that if there is no time frame, whenever you have a building site or construction, once you have that, that is your PE. Right? So if you don't want to have a PE, you cannot have any building site or you cannot have any assembly project, whatever. Yeah. One needs to examine the article on PE of the relevant country, as there are some variations among countries. I mentioned earlier, kan? It's crucial to establish whether a foreign entity has a permanent establishment in Malaysia, as it will set up the momentum of tax system in Malaysia. If PE exists, then the income attributable to the PE would be subject to Malaysian income tax, where the enterprise having one or more of the above fixed placed, right, is said that to be trading in Malaysia. Bila trading in Malaysia, then that company has to pay tax in Malaysia. All right, additional definition of for PE. So this one is also important because the above one is the general ones. All right, then you have to look further. An enterprise of a contracting state shall be deemed to have a PE in the other contracting if it carries on supervisory activities in that other state for more than 6 months in connection with a construction, installation, or assembly project which is being undertaken in that other contracting state. Such similar provision also found in Article 5, Para 4, Malaysia, Japan, 1999. So not only looking at that, but also if you provide supervisory, you don't have to be there. You don't have, for example, you don't, as a foreigner, you don't have to be in Malaysia to provide supervisory. All right, now you can do, for example, now you can do online. All right, but if that supervisory activities take for more than 6 months, for example, in this case, all right, then you have the PE. Okay. Agency contractual. So when talk about agency, you're talking about if you have an agent in one country, all right, does that agent represent PE or not? All right, agency contractual relationship. So kita panggil agent lah, agency, right? Foreign enterprise that use independent agent, broker, general commission agent to market their products in Malaysia will not give rise to the establishment of PE in Malaysia. Generally, all right, no profit will be taxed on such business income as the foreign enterprise is merely trading with. Bila you cakap pasal independent agent, right, generally it's a trading with. Bila trading with, you don't have to pay tax in Malaysia. Example, Disneyland Incorporation is a manufacturing company in New York, US. Right? It manufactures Mickey Cat t-shirt. The cost of the t-shirt is 30 ringgit, while the selling price in US is 45 ringgit, both translated from USD. In 2019, the company sold 500 Mickey Cat t-shirt to Ahquai, an independent agent in Malaysia, for 35 ringgit per t-shirt. The gross income, 17,500, by whom would not have any Malaysian income tax exposure. Well, how do you get 17,500? 500,000, 500 ringgit, 500 units of t-shirt times by 35 ringgit, isn't it? 500 times 35 is 17,500. So who's the, in this case, 70,500 income of the US company, because why? The company purchased from them. So in this case, they have a business in Malaysia, right? But would that subject to withholding tax or subject to PE, for example? No. Why? Because in this case, all right, the US company, Disneyland Inc., do not have PE in Malaysia. Dia tak ada business, dia tak ada office in Malaysia in this case lah. No office, you just that sell je pada Ahquai. Right? So in this case, you just sell, you don't have any PE. So you're just trading with Malaysia. When you're trading with Malaysia, then it does not give rise to a permanent establishment, so you don't have to pay tax. Yeah. However, so dia suka perkataan Perkataan however. Very important ya. When you have however, in the event that a dependent agent. So kat atas ni kata independent agent. Independent agent ni maknanya you just buy and sell macam tu je. Alright. But a dependent agent, in this case a sole agent, is appointed by a foreign enterprise to market their product in Malaysia. Such appointment may establish PE if any of the following present, any one of these. All right. Number one is that he has and habitually, so it means that this agent, all right, the agent has and habitually exercised that first mentioned contract state and authority to conclude contract, right? So talking about agent, you're just an agent, all right? The seller is the US, for example, and you're selling it to a Malaysian counterparts, all right? So as an agent, you take contract between Malaysia, this Malaysian and US. The contract is like between you and agent and the seller, the buyer. But you being an agent for Malaysian and US, right? So in this case, you conclude contract for them, all right, unless activity are limited to the purchase of goods or merchandise for the enterprise only. All right. So kalau you buying and selling, all right, then you are no longer a dependent agent. So if you are able to conclude a contract, then contract maknanya buying and selling ya. So but if you only buy from the other parties, no PE. But if you buy and sell, all right, then you can conclude contract. In that case, you have a PE. Maintains, all right, in this case, the US stock of goods or merchandise belonging to the enterprise from which he regularly fill orders or deliver goods and merchandise on behalf of the enterprise. So in that case, he also has a permanent establishment. All right, means that siapa yang ada PE? Dia ada US country lah. All right, the US has a permanent establishment by the existence of this dependent agent. Alright, in so acting, he manufacture pula or process goods or merchandise belonging to the enterprise in that first mentioned contracting state for that enterprise. So in that case, alright, you also have PE lah. So it means that now, if you are agent, it could be a PE, it could not be a PE. If you're only buying, alright, it's okay. But if you are buying and selling on behalf, then you have PE lah. Alright, and then you have pula stock, maintain stock, and then you sell, deliver everything to, means that the responsibility is higher, okay? You have to be continuing activities or active conduct of business in Malaysia in order to consider a PE in Malaysia. Okay, let's see. Super Inc. is tax resident in the UK, enters into contract with its customers in Malaysia for the sale of pharmaceutical product manufactured in the UK. All sales contract between Super Inc. and its Malaysian customer are concluded outside Malaysia. Acceptance of purchase orders and issuance of invoices are done by Super Inc. but transmitted via a Malaysian agent who has no authority to conclude contracts on its behalf. To ensure prompt delivery, Super Inc. leased a warehouse in Singapore, all right, for storage and delivery of its goods directly to its customer in Malaysia, at which time title to the good passes. Advice whether Super Inc. would be deemed to have PE in Malaysia? No. Why? Number one is that because there's no PE, no maintenance of stock in Malaysia. Stock dia buat kat mana? Kat Singapore. Kenapa dia buat kat Singapore and not in Malaysia? Maybe, alright, the tax rate in Singapore is lower compared to Malaysia. That could be the reason. Why not you have stock in Malaysia je terus because you are selling to Malaysian. Right, but in this case, they ought to have their stock or warehouse in Singapore rather than Malaysia. No maintenance of stock in Malaysia for purpose of fulfilling orders. No agents in Malaysia with authority to enter into contract on behalf of Super Inc. and no branch office of its place on business in Malaysia. So in this case, all right, we cannot claim any tax from the Super Inc. company, all right? But I'm sure that Super Inc. actually paying tax to Singapore. So siapa yang untung? Singapore lah. So for that, all right, Malaysia may want to review lah. Why is it not that the company Super Inc., of course, we want the Super Inc. to have their business in Malaysia rather than in Singapore, all right? So you have to find lah what kind of incentive that you can do a lot more to attract more companies to have their business in Malaysia, all right, rather than with Malaysia. Why? Because you have in Malaysia, then you can collect tax, all right? So the tax is a revenue to the government. When you have found to have a PE in Malaysia, then you have to pay tax 24%. So maybe again, tax rate in Singapore is lower. I do not know how much the tax rate in Singapore. Anyone, any idea? Right, it should be noted that PE is established even though the non-independent agent operates without a fixed place of business. It doesn't have. Alright, kalau dia katalah the non-independent agent, even though there is no fixed place, tak ada office, tak ada apa-apa, buat kat rumah je, for example, right, online je, but still if you able to conclude, for example, authority to conclude contract, then you still fall under permanent establishment. Okay, what activities that do not constitute a PE? Alright, so you must always be careful. Katalah, it depends lah. If you want to have a PE, maybe you doesn't matter. But if you do not want to have PE, you have to make sure that this thing, you don't have this. Yeah, the use of facilities solely for the purpose of storage or display of goods or merchandise belonging to the enterprise. Alright, you imagine that this company just now Disneyland tadi. Right, you are an agent, alright, and you have their products, but only for the purpose of storage or display. Right, so in that case, you don't have a PE. Right, maintenance of stock or goods belonging to the enterprise solely for the purpose of storage or display. Again, right, not only you have facilities for the purpose, but you also have maintenance of stock. Yeah, maintenance of stock of goods or merchandise for the purpose, solely purpose is for storage or display. Maintenance of goods or merchandise belonging to the enterprise solely for the purpose of processing by another enterprise. Sometimes Malaysia is used as a place before it being processed by another enterprise. Okay, you are the storage kat situ, yeah, maintenance. Fixed place of business solely for the purpose of purchasing goods, right, of merchandise or for collecting information for the enterprise. So in this case, you can have fixed place of business, but right, only to purchase goods, right? You don't sell, you just purchase so that you maintain stock lah, yeah. And the maintenance of fixed place of business solely for the purpose of advertising, for the supply of information, scientific research, or for similar activity which have a preparatory or auxiliary character for the enterprise. Another example here, we have Bond Limited is incorporated in the UK, sells shoes manufactured by an associated company in Europe to distributors in Malaysia. So you can faham dia punya scenario, right? Incorporate in UK, manufactured in Europe, and then distributed in Malaysia. In order to promote its business in Malaysia, it has set up a liaison office here staffed by a manager and 2 clerical staff. The sales contract have been concluded outside Malaysia. Apart from sales income, it also derives interest income from its Malaysian distributors when they fail to pay on time the purchase price for shoes which have been ordered. Advise Bond Limited whether it's liable to tax in Malaysia on its business income and interest income. Okay. The answer here says that first issue to be determined is whether Bond carries on business in Malaysia through establishment of PE. Assuming for the moment that it had no PE here and it had no salesman, concluding contract on behalf with the distributor in Malaysia, it would be clear that company could not be said to carry on business in Malaysia. Okay. However, it has set up a liaison office in Malaysia on the facts given the sales contract have not been concluded in Malaysia. On the basis of this analysis, therefore, Bond would not be subject to income tax as it does not carry on any trade or business in Malaysia. It merely trading with Malaysia. Business income from the sale to Malaysia would not be taxed. And what about the interest income derived by Bond? Taxability is debatable as we do not know how the interest became payable. Remember, because talking about interest income, all right, will only be taxable in Malaysia. You have to look at the derivation of the interest income, right? It has to be the interest, means the interest on loan. So how do you use the loan? Is it for business purpose or otherwise? Yeah. Was it payable under separate bill or exchange drawn to the So this one is the advanced level. Yeah. However, since the interest is an integral part of the trading profit in this regard, remember the interest is because late payment or cancellation of payment. Applying the fact on the matter, the interest should be excluded from tax because it has a source outside Malaysia. That is, it will be a source where the sales contract were concluded. Okay. All right. So how far, memang this topic is theoretical. All right. In your exam also, most likely, the question is a theoretical short essay. All right. I can ask you about double tax agreement, about permanent establishment, about the method of elimination, right? And I can also give you a scenario. You have to decide whether subject to tax in Malaysia or not based on the permanent establishment. Yeah. So the next one is a lease rental on ships. Right? Lease rental on ships means that you have a ship that you pay. Lease rental on ship means that it's an income on you lah. Right? So let's see the example here. In Lembaga Hasil Dalam Negeri against Alam Maritime Malaysia Sdn Bhd, the company carries on business of vessel hire and management. Between 1998 to 2004, the company paid charter fees to non-resident company operates outside Malaysia for the supply of ships. So the company paid charter fees to non-resident company, right? So it means that the non-resident company now receive income under Section 4 Big A. What is Section 4 Big A? Rental of movable properties, right? Ingat that Section 4 Big A? Section A is business income. Section 4 Big A, income received by non-resident person. If you look into your Malaysian textbook, on second page, right? Page 2, first page actually at the bottom. Page 1 actually, and then continue page 2. That talk about income of a non-resident person. One of it, income of the renting of movable property. So in this case, you're talking about the ships or the vessel. These non-resident companies are mainly from Singapore. The payment despite embed of Section 4A3, I mentioned earlier, right? No withholding tax was paid as the non-resident company do not have permanent establishment in Malaysia, therefore able to seek for relief under Article 4. So what happened is that, all right, in this case, you're talking about Alam Maritime. All right. Alam Maritime paid to a non-resident person. Okay. Paid to a non-resident person, in this case, is a Singapore company. Right. By right, because this one non-resident person and this one is Section 4A under 3, which is subject to withholding tax. Okay. Subject to withholding tax. So what happened is that in this case, all right, Alam Maritime failed. No withholding tax was paid as the non-resident company do not have permanent establishment. So isu dia sekarang ni, dia tak claim withholding tax. Alright, sepatutnya by right, the company should withhold tax payment to non-resident person sekarang ni. Alright, because why? Dia lease rental. Alright, you have to pay to this for the payment for the rental of the vessel. So this one is the income lah. Alright, income. Alam Maritime paid rental. So this is an expense, right? So how much you pay? For example, you pay 100,000. By right, assuming that the tax rate is 10%, right? 100,000, you cannot pay everything to non-resident. You have to pay only 90,000. You have to withhold 10% tax because why? It's subject to Section 4A3. So you have to withhold tax. But the problem is, in this case, there's no withholding tax. Why? On the basis that this company has no PE. Right? Withholding tax and permanent establishment is two different things. Alright? The issue of PE, whether you have PE in Malaysia, whether you're subject to tax on the income of that company. But withholding tax, as long as you are non-resident person, income fall under 4A, for example, then you have to pay withholding tax. Alright? It doesn't matter whether company is a PE or not. Right? So let's see that the argument given in this case, because you have to understand the case first, yeah? Where is it at? No withholding tax was paid, all right? No withholding tax was paid as the non-resident company do not have permanent establishment. Therefore, able to seek for relief under Article 4 of the Double Tax Agreement. Okay, dah boleh main dah. Alright, it says that the income profit Singapore enterprise shall not be taxable in Malaysia unless the enterprise carry on business in Malaysia. Itu PE, alright? Though a PE situated in Malaysia, if the enterprise carry on business as aforesaid, tax may be imposed in Malaysia on the income or profits of the enterprise, but only on so much. Okay, never mind. The company relied on double tax agreement for relief of withholding tax. It is an accepted general principle of double tax convention that an enterprise of one state shall not be taxed in the other state unless it carries on business in that other state through a permanent establishment. So we agree that, right? Permanent establishment looking at the business. So in this case, of course, the company do not have any PE in Malaysia. So you don't have to pay tax in Malaysia. But the income that you receive is subject to withholding tax. So it's two different things, right? Business tax on business income and tax on your income here is different, right? Business income 4A, all right? In this case, rental income under section 4A, big A, 3. Okay. Okay, what happened is that the Court of Appeal concurred with the High Court decision that in accordance with the Avoidance Double Tax Treaty entered between Government of Malaysia and each of the government or country in which the non-resident company operate their respective business, income received by them are taxable as business income in the country where they actually reside or originate. So in this case, Singapore lah, alright? As the provision of DTA takes precedence over the Act, the company is therefore not obliged to make deduction on withholding tax. Okay, kat sini dia kata apa? Not obliged. Alright. Siapa yang cakap ni? Court of Appeal dengan High Court. Okay. Not obliged to make deduction of withholding tax in respect of payment to the said non-resident company. Upon further appeal to the Federal Court. Okay. You kena faham. Dia mula-mula, dia kalau tax ni, mula-mula dia akan pergi High Court. Lepas tu dia pergi Court of Appeal. Last kali baru pergi Federal Court. The Federal Court acknowledged the importance of DTA to avoid double tax. However, opined that Article 4 of the double tax must read together with Article 2, Article 2.1 exclude the application of income derived from the operation of ships or aircraft. Right? Because it doesn't, dia tak masuk dah tu. In the case of lease rental on ships or aircraft, the issue of no permanent establishment is irrelevant. So I mentioned just now, it's nothing to do with the PE, right? It has to do with the withholding tax provision. Section 4A3 applies to payment of charter fees to non-resident company. So at the end, I believe that because the last one is federal court, so you cannot go any further court lah, right? Federal court kata withholding tax still have to pay, alright? Even though you don't have any PE, you still have to pay withholding tax. Alright, again I say that of course DTA is higher than local, but remember that the DTA talking about the permanent establishment. Alright, tax regard to withholding tax still have to pay whether it's a lower, maybe lower rate, alright, or maybe exempted, but in this case it doesn't mention anything about that. So at the end of the day, alright, maritime have to are subject to penalty lah because they do not withhold tax, right? So remember, if you're talking about withholding tax, alright, one of the penalty for non-compliance is that you have to pay 10% of the non-withholding or amount is non-deductible expense, whatever lah, right? So that's the case. Okay. This one is the response of the, this is where you mentioned about DTA overrides income tax, huh? All right. Because you have to, DTA is the international level. Tax sparing incentive. Okay. What is a tax sparing? All right. Tax sparing provision embodied in several DTA. Tax sparing is used to preserve the incentive which are provided in Malaysia to encourage foreign investment. In normal circumstances, a tax credit is only available under double tax agreement if tax has been actually suffered in the foreign country. Consequently, any tax that is foregone by the country which provides special tax incentive would be of little use if the foreign investor had to pay the full tax on the overseas exempt income in his home country. Investor ultimately would not enjoy the exemption granted by incentive. Hence, tax sparing is provided to the foreign investor for the exempt income derived. Tax sparing relief. The effect of sparing is that overseas tax foregone by the overseas state is treated by a home state as if tax has been. Okay, what happened is that, remember that you got pioneer status investment tax allowance, where it says that, okay, your statutory income 70% is exempted, you only have to pay tax on the 30%, right? So let's assume, assuming that your statutory income is 100,000, so 70% is abated. So you only have to pay, for example, pioneer status, your deemed income, no other income. Your deemed income 30% is 30,000. So you pay tax on that 30,000. How much tax that you pay? 30,000 times by 24%. So you only have to pay 7,200 tax. Alright. So remember tadi kita pakai tax exemption, not tax exemption, bilateral tadi, tax credit, right? So the amount of credit given to you is the 7,200. Oh, all right. So, but of course, in that case, the company that is under pioneer status would be losing lah, because the amount given as a tax credit is very small because they only have to pay small tax liability. due to the tax incentive given by the country, for example, Malaysia. So what they want now is that they want the tax credit given is based on the total income rather than the actual tax liability paid by the company, all right, the net amount. So for example, here pioneer dividend paid by Malaysian pioneer company to Singapore resident will continue to be exempt from Singapore tax by virtue of tax sparing relief. All right. A Singapore resident company may declare itself to be a Malaysian resident for the purpose of declaring dividend. As such, a two-tier dividend would be also available. All right. Okay. This is where we say that the example on the pioneer status, Farm Cow Limited is a tax resident in UK, receive Malaysian subsidiary dividend of 40,000 in financial year. Dividend is declared from the exempt income of Malaysian subsidiary which are currently enjoying pioneer status. So because they pay out from exempt account, the dividend is exempt dividend, right? So it means that the company do not have to pay anything, don't pay any tax. But we talk about this is because of the tax incentive. So it means that the company pay no tax on the income, but they still want to get the tax credit, all right, on the income received in Malaysia. So in UK, 40,000, and then corporate tax in UK is 90%, so 7,600. So you want to get a relief assuming that, all right, on that 40,000, even though it's a tax exempt dividend, means that the company do not pay any tax, all right? There's no tax imposed on the dividend because why? Dividend is exempt, dividend paid out from exempt account, right? But we assume that, all right, even though you don't have to pay any tax, so remember tax credit, you are going to, whatever tax that happens, 7,600, you are given credit on tax that you pay in other country, whichever is lower. So they still assume that as if they actually pay tax on that 40,000. How do you get that 40,000 times by Malaysian tax rate lah, times by 24%, which is 9,600. So the whole amount given as a tax credit, as a result, you don't have to pay any tax in UK on the income that you receive from Malaysia. All right. In this case, you are applying actually the tax credit method. Yeah. Not tax exemption, but tax credit method. Okay. I will stop here. All right. 3:20 already. I will stop here. Then we are going to look into exemption of employment income next class. All right. And from next class onwards, all right, be prepared for your presentation. Yeah. Group presentation of your group project. I only have one more topic, which is the transfer pricing. So if I don't have any guest lecture or I couldn't find any material on the transfer pricing, let's assume that that topic will not be covered this semester. So now we only left with, for example, let me see that. Lesson plan. This is 4243, right? So just look at that. We have covered your estate, your trust. We have covered your tax planning. Please correct me if I'm wrong. Right, we have covered your investment tax incentive. Ni nak kena buat. Dah. Okay. Cross-border activity we have covered today. All right. All right. Now we go into your, because the topic here, can you see this now? All right. The topic here is not according to the group actually. All right. So I want you to decide among yourself lah. Right. Who to present in the following weeks. All right. It could be first come first serve basis. Last come last serve lah kot. Last come first serve. Boleh? Macam tu. Alright, so we have week, next week is, I say that next week is week 10 actually. Week 10, 11. Ni kenapa 10 balik ni? 12. Salah dah ni. Alright. Audit investigation, hopefully that Dr. Sawa punya slides, I can use that. Alright. And then transfer pricing, I may have to, ada tak strike off? Tak jumpa strike off. Dia tak bagi I strike off. Format, tax, strike through. Boleh? Alright, so I may not want to cover that topic unless I could find a replacement for that. Alright, so means that I only have a small part on the double tax agreement, then I can pass it to you all right, I want you to manage yourself who are going to present. I do not want to have a session without any presentation. So make sure that we have how many groups? 10 groups, kan? How many groups do we have? I think 10 groups, all right? So we are going to divide, please divide among yourself. When is your schedule for presentation? All right, so I think that's all for today. I thank you for your participation, right? Even though not much participation today lah.